Hey everybody, this is Noah Kelch here in beautiful Salt Lake Valley. Going to be presenting a webinar tonight, going over some introductory, more getting back to basics on this one. So anyway, I'm going to get started here. We got a lot to go over. Hopefully everybody's on who is going to be. And or hopefully we'll be joined by others. Anyway, I'm going to get started here. So a brief introduction to myself. Again, my name is Noah Kelch. I'm a wealth strategist here at Paradigm Life. I grew up just a little bit outside Park City, Utah here. So born and raised here in the mountains. Love the outdoors. Spent a lot of time in the outdoors. During the summer times, hiked and biked and did about everything you could in the outdoors. Wintertime, spent a lot of time on skis, snowmobiles, you name it. Just really love the outdoors. Started my working career in the early 90s. Bought my first house in 1996. Got married in 1997 to my beautiful bride. And we started a young family. A little after 2000, I had a financial aha. I would imagine many of you, sorry, I'm getting some feedback here. You can't hear. Is that a little better? Can you hear me now a little better? Go on. Anyway, had a financial aha around 2000, and when we about became a financial splat, if you will, and started thinking about money and finances in a completely different manner. Found out I had a really true passion for finances and numbers, and told my wife back in 06 actually that my dream was to be in the financial industry and to assist others in understanding finances and to better their financial life. Anyway, one thing led to another, and in early 2012, January 2012 actually, 2013, come on board with Paradigm Life and have been here ever since. Absolutely love what I do. Have a lot of wonderful clients, and I get to meet new and exciting people all day, every day, and talk about what I'm passionate about. So this is really fun for me. This year will be our 19th anniversary in August for me and my wife. We've got 4 wonderful kids, still love the outdoors, and now I get to enjoy it with a larger group. So have a lot of fun. Anyway, let's jump into this. So when I was first thinking about this webinar, I thought, we a lot of the webinars are based on kind of more advanced concepts, and so I thought, well, I think it might be a good time to have to really pull it back and go back to basics in not just why whole life insurance, not necessarily whole life insurance, but insurance in general, why life insurance in general, and talk about some of the whole life attributes there. So I'm gonna talk about some of the whole life attributes. I'm going to talk about some term a little bit, and then also, what is a paid up addition rider? I get asked that question quite often. What is a paid up addition, and how does it work? So I'm gonna cover that. I'm actually going to kind of dissect the policy, if you will, and we'll take a look at both sides. Both a traditional and a policy with the paid up additions rider, the way we structure them here at Paradigm Life. So you get a good idea of what that looks like. There it is right there, properly structured. Then we're going to talk about maximizing cash value accumulation, increasing death benefit, and then actually look at a policy. We're going to look at a policy and see how the numbers work. So for those of you who stay with me throughout the time, or who have joined me early on, this is going to be highly beneficial if you've never seen or understood all the numbers in the illustrations. This should really help them to make sense. So we'll dive into that. Also, of course, protecting from market volatility and hefty taxes. Taxes is something that everybody has on their mind right now. We'll talk a little bit about that. Whole life insurance is a vehicle that can be used as a wealth accumulation outside of Wall Street, if you will. So you can accumulate wealth outside of Wall Street and then be able to utilize it for many different things: banking, other investments. Teach your family about banking and the concepts and different things like that. So let's dive right in here. I've got a lot to go over. I'll try to keep it to about 45 minutes, and then open up for some comments and questions, and see if we can't answer some questions there. So I have a question here. Can you make the font darker? Yes, it will be. This was a light gray, but most everything I will be doing will be in black. So let's talk about first of all I'm going to jump back over here. I want to talk about what matters most. What matters most? So when an individual, or typically when we talk about, hey, what matters most? What are some things that you insure for? Oftentimes the responses we get are, my house. My house is an asset, and I do like to protect it, so I do have insurance on it. Cars come up a lot. Cars, we like to insure cars. And when we insure these things, we insure them at full value. And then we might have businesses, businesses usually come in there somewhere, and toys end up in here as well. RVs and the like. Anyway, the number one asset that we have as individuals is ourselves. So I'm going to say you, and then secondly, or right there with it, is a spouse or a significant other. Now, why do I say that? Well, because without you and a spouse or a significant other or loved ones, family, to enjoy the house, the cars, business, and toys, what's the point of having any of that stuff? So from a very, very basic standpoint, you are the number one asset. And these other things, the houses, the cars, the business, and the toys, you typically insure them for their value. So you and your loved ones also have what's considered a human life value, HLV. Human life value. Now I know that there's no possible way to put a value on a human life. It's just not possible. There is no monetary value that equates to a human life. However, based on your ability to earn, this is what this human life value is based off of, and the insurance company has that to go off of. So, and this will depend on your age and of course your earning ability. So an individual, according to the insurance company, is going to, their human life value is going to vary depending on age, and earned income, and sometimes passive income, different things like that, and then also net worth. So there are a lot of factors. At the end of the day, though, a lot of individuals are underinsured when it comes to themselves. Okay, so I just wanted to touch on that a little bit. Okay, so let's dive into different types of insurance. Okay, term insurance definitely has its place. When you're covering, a good place for term is young families. Why is term a good thing? Well, you can get 10, 15, 20, and oftentimes 30-year term that will protect. Let's say you need a significant amount of death benefit while you have young kids in the house, or while you have a mortgage on a home or a piece of property, or whatever the case may be. Some shorter terms are used for vehicles and shorter term loans. So you can actually buy a life insurance policy or term insurance that decreases or goes away once a specific item is paid for. Then you have a traditional whole life. This is going to be how most whole life is written. Actually, traditional whole life has been around for it's a little over 200 years. The kind of insurance that the type of whole life that is traditionally used nowadays, and I won't get into too much history there, other than it's been around for a long time. It's tried, it's proven, it's a great product all by itself, and it does accumulate some cash value, and we'll get into that a little bit today. It accumulates cash value. Some policies can have an increasing death benefit, but it takes a long time to accumulate that. And then we have what we've got that Paradigm puts together here, and a wealth strategy, whichever wealth strategies you've either talked to or will be talking to. We put together a whole life that is built on actually the traditional chassis, but we have what's called a paid up additions rider. Okay, paid up additions rider is simply a rider that we add to the traditional whole life policy. Paid up additions meaning it's a whole life insurance that you pay for one time, and it's in addition to your existing policy. Okay, we'll get into those things. So let's jump in here. Okay. So first I'm going to talk about term, and then we'll back out of that and talk about some of these other ones. So if we're talking about term, that's essentially the equivalent of renting a policy for a period of time. Like I said, 10 years, 15, 20, 30 years, however long that is. And typically, as long as you're healthy, at the end of that time frame, you can renew for another term policy or another whole life if you'd like, whatever the case may be. But as long as you're healthy, you can continue to get this term insurance. It's typically a lot less expensive, or out-of-pocket cost is much less for the amount of death benefit you have. The reason for that is because, based on actuarial science, the insurance company knows that you're going to outlive that. Now, there is a certain amount of people that do pass away with term insurance, and that's why it's there, for just in case. But typically you're renting insurance, and so you have zero cash value accumulation. I'm going to start putting these down here. Zero cash value accumulation, and with a term, this is the case throughout. Okay, so when you're done with that term insurance, you have zero insurance, so the death benefit goes away, and you have zero cash value. So you're essentially renting the insurance, like I said. So that's term insurance. I'm going to jump into a traditional whole life. We'll talk about that a little bit. So down here, I'm going to, and for the purposes of this webinar, I'm going to use a 35-year-old $10,000 contribution. So let's say we have $10,000 going into this per year. And let's say that death benefit starts out at, let's say, $1 million. Okay, $1 million death benefit. So I'm going to come over here and say $1 million. All right. So with a traditional policy, 100% of this $10,000 is going into what's called base. I'm going to refer to it as base. Now, with a whole life policy, there are some expenses in the policy in the first few years, and so you're still going to have this zero cash value for this time frame right here. Some of the things that would come out right out of the beginning of the policy is agent commission. Although I do this for a living, or I do love what I do, I also do this for a living, and so and I get paid to do it. So my agent commission comes right out in the first year. Also, there's going to be a nurse that comes out and does a medical on you. The insurance company has underwriting they get to do. They get medical records from your doctors. Sometimes those have to be paid for. There are a lot of expenses to start these whole life policies. And so instead of handing you a bill in addition to this $10,000 contribution, they say, well, in the first few years, we will just withhold any cash value, and that's where we're going to recoup our costs. So after the first few years here, you start to accumulate cash value, and I'm going to put them in percentages: 75%, 100%, and this I will just keep going down the line here a little bit, just so you get an idea. Okay. All right. So again, this is a traditional whole life policy. Okay. We're going to get into the paid up additions in a minute. So traditional whole life policy, we contribute $10,000. It goes all towards base. In a few years here, you accumulate some cash value. Okay, so in the fourth year in this, and I'm grabbing numbers out of the air for this, but in the fourth year we have 25% cash value accumulation based on that year's premium. So in this year we have $2,500 in cash value. Now typically, if you were to go to the agency down the street and ask them, hey, I want a whole life policy and I want the paid up additions, this is what they're going to give you. They're going to give you a traditional whole life policy. They're going to put 100% of the contribution to base, and when you have this cash value, you'll start to receive growth and possibly some dividends on it if it's a mutual company that they're working with. Okay? If not, then some of them just have guaranteed growth. When you receive the guaranteed growth, oftentimes that comes in the form of a dividend. Okay? Typically it's more with mutual companies, but again, some stock companies also offer, they do some kind of sharing there, where you may accumulate some additional paid up additions. Again, these dividends, very small, would purchase a small amount of fully paid up insurance, and this is how the paid up addition is typically looked at. So a couple of things I want to point out here. First of all, I have this 100% mark. What do I mean by 100%? Now again, I'm talking about cash value. Cash value. So in this year, you have 100% cash value growth relative to that year's contribution. So in this year, you have $10,000 increase in your cash value. That's what I mean by 100% growth there. And then another thing I'm going to be pointing out is the break-even point. What do I mean by break-even? I mean, in what year does the does the cash value, again, cash value, break even in a traditional whole life policy? And that's typically between years 15 and 20. Now, this is going to vary based on age, based on health, and different factors, but typically with a traditional whole life policy, it's going to be anywhere from 15 to 20 years. Okay. This 100% mark typically happens between about 7 and 10 years is when you're going to accumulate cash value of 100% of your contribution. Okay. And that's about it for that one. I've got some percentages that go above and beyond that, and this is I will do some explanation. It's up here, so I'm going to explain it. Your cash value will end up, again, they're percentages. Your cash value will end up increasing by a greater amount than your contribution. So that's why I have it as a percentage: 120%, 130%. And this isn't going to, I just drew up some lines here. It's not relative to the exact time frame, but you get the idea. This is purely for concept. So now I'm going to jump over and talk about paid up additions. And then the effect it has on the policy. So first thing we're going to do is, and again, that your wealth strategist, whoever your wealth strategist is, oh, please tell me it's not frozen. It just froze on me. Give me just a moment. I'm going to... Okay. So, with the paid up additions, we're going to split this out, and this $10,000 we're going to, and I'm going to do this based on the illustration that I put together for this meeting. I'm going to put $4,000 towards the base and $6,000 towards the paid up additions rider. Okay. Now, obviously, we're not putting as much to base, and so our death benefit is less. Remember, I had $1 million over here. Now I'm going to start this out. Let's say this starts out at $400,000. Okay. Okay. Kind of squishing up there. Let me drop that down just a little bit. Okay, 400,000. Okay. So, paid up additions, how they work. Again, in this instance, $6,000 going into the policy towards the paid up additions. This also purchases whole life insurance. It just purchases it in a different way. You're paying a one-time cost. In this case, it's $6,000. It's purchasing a specific amount of death benefit. In this case, we're going to say $25,000. And it also comes back to us as cash value early on. Now, this $25,000, I'm not going to put a minus, I'm going to put a plus here. Plus $25,000. This $25,000 does not have to be purchased ever again. That's a single premium policy. All right, I mean, it's single premium death benefit. So it does not have to be contributed to for that amount anymore. Now, every time we do this, now I've got it here 4 times. We've contributed 4 times here. Okay, in this illustration. So we've contributed $6,000. We've got an additional $25,000 of death benefit, and it comes back to us and starts at about 92% available cash value. Now, this is where I've talked about the properly structured whole life policy, because when you structure it properly for cash value accumulation, the death benefit is going to be a side effect, and it's going to continue to increase. Okay, it has to. I mean, this is a whole life policy, but we've got this cash value accumulation. I'm going to put down here $5,500 in the first year. So we've contributed $6,000 towards the paid up addition, purchased an additional $25,000 of death benefit. It's come back to us at about 92% efficiency, or approximately 92% of what we contributed is available as cash value immediately. Okay, and then you have guaranteed growth and dividends on that cash value, and so it increases to approximately 95%. Again, this is going to be dependent on age and health, and mode of premium actually makes a difference as well. So the next year we contribute another $6,000. We have another $25,000 of death benefit. Comes back to us another 95% of it. So we have an additional $5,500. Now I know my math isn't exactly correct here. I am doing this purely for concept. We will look at the illustration in a minute here. This is to get the gist of it. Okay. So the effect of this cash value accumulation on here, what that does to the policy is it's going to accelerate a few different things. First of all, remember how I explained before, in the fourth year in this illustration we had $2,500. Well, now in the fourth year in this with the paid up addition, we've had cash value in year one and every year thereafter. So now we've got $22,000 in year four, plus what's ever been happening on the whole life side. Okay. The effect of this, and this has a couple of different effects. First of all, this death benefit is in addition to the base policy. So you can see here in this illustration, in 4 years now we have $500,000 in death benefit instead of $400,000. And then this 100% mark, again, your cash value increasing by 100% of your contribution. We like to see this within 3 to 5 years. And then the break-even point, we like to see this between years 7 and 10 instead of 15 to 20. A couple of exciting things happen around this time frame, give or take 7 to 10 years. Okay, it's going to depend. A couple of exciting things happen. First of all, break even. Again, if you canceled this policy after you've broken even, the insurance company would send you a check for 100% of what you had contributed. That's the break-even point I'm talking about. Okay, your net cash value is what they will send you, and so at that point, I mean, now this is a long-term investment, but at the end of the day, if you can get back 100% of what you have contributed and possibly a lot more, versus a term policy where you're renting it, which one becomes more expensive? At the end of the day, the term policy would be more expensive because you have no cash value, and again, based on actuarial science, you're going to outlive that term policy. So you have no death benefit, you have no cash value. This whole life or the permanent policy, you do have cash value. So even if you were into it long enough to break even and said, hey, look, I just don't want to lose money, accumulate it long enough to not break even, you could walk away from it and it had cost you nothing. You had a significant amount of death benefit throughout that time frame in the event something would happen to you. Now, hopefully that's not the primary motivating factor for these policies. We want to use the cash value, and we've talked a lot about utilization of cash value in other webinars. Also, your wealth strategist is going to have they're going to have a lot of knowledge based on how to utilize a policy, and then we've got a lot of information on our website, paradigmlife.net, about utilization. So hopefully that's the primary motivating factor for these policies, and the death benefit, because the death benefit is highly important. I can see I've got a few questions coming up. I'm going to address those towards the end. I'm going to just kind of keep moving through this. For those who have been with me since the beginning, I'm going to continue to move through it, and then I will try to address any questions that have come up towards the end. So please bear with me. So let's jump over right now and look at the actual policy that goes along with this illustration. American United Life Insurance Company is one of the companies we use. They've been around for 138 years this year. Like I say, it's just one of them. I selected this one. It was open when I was putting together some information here. I based this off of a male, age 35. His name is John Doe. Standard non-tobacco underwriting class. I picked 35 because it's kind of the middle of the road. However, I will say that you can take this same contribution. The death benefit will change, but the same contribution is going to be very effective. From 20 years old or even younger than that, up to could be up into the 70s, and the policy will be structured different depending on your age, most definitely. And again, your wealth strategist here at Paradigm Life will know how to structure it based on your age. So if you're 60 years old and you've joined us and you're 60 years old and you're saying, oh my gosh, he's doing it on a 35-year-old, what business do I have even listening to this? You do have a lot of business listening to this, because again, this policy can be adjusted for a 60-year-old, 70-year-old. We write them for 80-plus-year-olds. We just structure it slightly different so they can still receive the benefit and whatnot. So, okay, a couple things here. I told you about the base policy. We went over the base policy, the base whole life insurance policy, and the contribution there is $4,000. That's going to match this. This is a required premium, absolutely required for the life of the policy. Okay, this is going to cover the traditional whole life policy. Now, this is the chassis, the base chassis. Okay. And we've got this paid up additions rider. Again, $6,000 there. This is a flexible premium. Flexible meaning you have the option with this particular company, and it's going to vary slightly from company to company. But with this one, you have the option to put in $6,000. You have per year, because this isn't based on an annual payment. You have the option to put in $120 and still keep that door open. So a lot of people are saying, whoa, $10,000. I don't know if I could do that. Well, you don't have to. If $10,000 is going to be a comfortable contribution, that's great. But if you run on hard times, if you change jobs, buy a new home, any life-changing events where you have to reduce that contribution for a short amount of time, again, the minimum here is $120 per year. So that's pretty dang flexible. Okay. Okay, we've got a base policy here of $376,000. Okay, we'll jump up here to the tabular detail, and this is where a lot of people can get lost, looking at all these columns of numbers, and we'll hopefully make sense of these. Couple of things here: guaranteed versus non-guaranteed. Again, this is a mutual insurance company, which means this type of policy does participate in dividends. So non-guaranteed is including dividends. Okay? Guaranteed, they have to put this on here because dividends or profitability of the insurance company is never guaranteed. So guaranteed means no dividends ever. Ever. Okay? This particular insurance company, American United Life, they've paid dividends. I said they were in business for 138 years. They have paid dividends consecutively for 137 years. That's a pretty good track record. That's one that I like. That's a good track record. Okay. This column here, cash value. This is the base. This is going to be in reference to the base column. The base right here. Okay, that we talked about. So we have these few years here of zero cash value. This is still the case. The company still has to pay those expenses, and they still have to come from somewhere. So you can see here, zero cash value in the first 2 years. In the third year, though, you start seeing cash value accumulation. Okay. In the third year here, again, we're contributing $4,000 towards this side. Okay. So in the third year here, we have 2608. The fourth year, well, look at that. We've got over $4,000 of increase, over 4,000 here, here, here. So there you have it. You've now not total cash value, but just on the contribution to the base, you've exceeded your contribution every year in your increase in cash values. Okay, and we'll get more into that. This paid up addition column is just what it says, paid up addition, and this is going to relate to the paid up additions that we looked at before. To this side, we are contributing $6,000. Okay, and in the first year without dividends, we have $57.46 available as cash value. Okay. Now, I told you our base policy here is $376. You'll notice here in the first year, our total death benefit is $403. So right there, and this is the first time I even looked at the death benefit, but that was a pretty good guess. $6,000 is purchasing approximately $25,000 of death benefit, or a little over $25,000. To be exact, it's $26,341 in the first year. So it's a pretty close guess. And you can see that every single year, that paid up addition death benefit is increasing year over year over year, as does your total net death benefit. Okay, this column here is a combination of base, cash value, paid up addition, cash value, and then dividend. Okay, so that totals it out right here. Now this one here, I mentioned before, it starts at about 92% at the beginning of the year, and then by the end of the year, it ends up coming out to be about 95% efficient. Well, we know there's no cash value accumulating in the base side in the first year, right there. So what this entails, what this is made up of, is paid up addition plus dividends. So let's see what that efficiency is for the dividends. The way I do that, I'm going to take that end of year cash value, which is 5832. I'm going to divide that by the contribution to the paid up additions, which was $6,000. Right there we have 97%. Okay. Again, I said it's going to depend on health. It's going to depend on mode of premium, age, different things like that. So in this case, it's 97% of our contribution towards the paid up additions premium is available as cash value in the first year. And then we go down here. A couple other things I wanted to point out. Where's our 100% mark? It looks like it's right there. Again, our contribution is $10,000, and our cash value in year 4 is $32,034. Subtract out the year 3's cash value, $31,163. we have cash value increase of $10,871. Our contribution, of course, is $10,000 in this case. So at that point, our cash value is increasing by 100% of our contribution at least. So this is 100% cash value growth relative to that contribution in that year. And I told you this typically happens in year 3 to 5 is where we like to see it. This one is happening right at year 4. That looks really horrible. Right there at year 4. Next thing is our break-even point. I said we typically like to see this between year 7 and 10. In this case, we've had $10,000 contributions. It looks like our break-even point is right here at year 8. This is where we break even. Total net cash value in a traditional whole life policy is the same as the surrender value. So, at the end of year 8, you've contributed $80,000. You could call the company up and say, I want to cancel this policy, send me a check for my cash value. They would send you a check for $80,440. No questions asked. I mean, other than, geez, are you sure you want to get out of this policy? You've got a $500,000 death benefit and utilization of $80,000. But if that's what you want, that's what you get. Anyway, so that's where the break-even point happens or is. Now, out beyond that, I told you that's where it really starts getting fun. The reason it does is because you've broken even at that point. Okay, to me, this is a fun point in the policy, right there. As soon as my contribution is increasing, as soon as my cash value is increasing at a greater amount than my contribution, well then I look at it and I say, well, personally, my bank account is growing because I use this as a personal banking system. My banking system is growing by more than I'm contributing, and my death benefit continues to increase year over year. How fun is that? But there's another something that happens at this point right here, and you can see what's happening here. If our if our cash value is increasing by 100% back here, let's see what's happening out here. This is just year 10 too. I mean, this is just getting going here. 122,620 is the cash value at year 11. I'm going to subtract out year 10, 107,912. Our cash value increased between years 10 and 11 by 14,708. We contributed $10,000, of course, so that's $4,700 of pure growth just in that year. And again, it's just getting going. We can look at this year, we can look at this year, we can look at all these years. The longer it goes, the more that increases. And that's why I had that 105%, 110%, 115, and 20, 30%. And then look at our death benefit. It started at $400,000 back here. Down here 20 years, it's more than doubled. We've got over $800,000. And it just keeps going. Okay? So that, well, we're already at 45. I do want to cover a little more information before we jump over to questions. And that is, how do I decide how much of this contribution I want going where? Okay? So this is kind of how it works. There's a minimum and a maximum that can be contributed for any amount of death benefit. In this case, let's say $500,000, just for fun. Okay? The minimum that you can contribute for this $500,000 is going to be a 1-year term called OYT for short, 1-year term. Okay? That's going to be the least expensive for a younger individual. At the end of the day, this is one of the most expensive ways you can buy insurance because every single year the cost of that insurance does increase, and the older you get, it increases substantially. Next we have, let's say, a 10-year term. Okay, and then we've got 15-year, 15-year, 20-year, okay, 30-year. Then we jump into whole life. Now, whole life is going to be more expensive. And again, we already went over this. The reason is because this is a whole life policy, not a term policy that you're renting. This whole life policy is considered a permanent policy. So the insurance company comes to the table with the contract with the understanding that at some point they will pay out at least $500,000. Oftentimes more because of the growth within the policy. And because it's a whole life policy or a permanent policy, you do accumulate that cash value somewhere in there. Okay? So again, you can pay a minimum for the whole life for this $500,000. And that's going to be that, again, your wealth strategist can go over this. And what's the best for your situation? Well, that's going to depend. There is no specific one of these that is perfect for everybody. It's going to depend on the individual. It's going to depend on the circumstance, the age, what they're trying to accomplish, whether they're looking at legacy or retirement, how they're if they're looking to utilize it. There are a lot of different factors, and again, your wealth strategist will go over this with you. When we jump into this whole life sector here, then we can start adding paid up additions. And the paid up additions is, and again, we're directly funding the paid up additions. What I call a properly structured whole life insurance policy, we are directly funding these paid up additions. This is not just something that's going to happen down the road. We are directly funding these immediately, like you saw in the illustrations. This paid up addition, you have a pretty wide range of amounts you can put in here. The maximum here is going to be a modified endowment contract. Okay, so typically your wealth strategist is going to structure it somewhere in this neighborhood right here. The reason for that is because we want some room in the top here for utilization if that's your intent. Okay. And then again, sometimes we want a whole life policy that exceeds that MEC line, exceeds that MEC line. Again, this is going to be in specific circumstances, typically for elderly individuals or those who are looking for legacy or have large lump sums and don't want continuous premium, different things like that. So again, it depends on the circumstances. But sometimes a MEC is a perfect policy. It does not change the fact that it's a great insurance policy. And I don't have time to get into this MEC other than it would. This is the IRS guideline. Okay, so when you hear MEC, it has to do with the IRS and the taxation of the cash value, not the death benefit. Taxation on the cash value. Anyway, again, your wealth strategist will go over that with you more in depth. Let's see here. Maximizing cash value. So this is a way to maximize your cash value. It's to have a specific amount of whole life, and again, your wealth strategist will know what that is, and then increasing that paid up addition. That's the way to increase your cash value or maximize your cash value. The death benefit, as you saw here, the death benefit does continue to increase the further down we go on this when it's properly structured. Now, this isn't the only way to accomplish this. Sometimes we accomplish it using some terms. Say this individual says, "Hey, look, I want to contribute $10,000, but I need $700,000 or $1 million of coverage." Okay, that's not a problem. Your wealth strategist will be able to accommodate that without any problem. I mean, that's a very doable situation with this one in particular. Wouldn't be tough to do. But so if you do have a specific death benefit you need to hit, that's certainly within reason to do that. We look at it. We look at a lot of different things when we put these policies together. Let's see. Cost of death benefit. I get a lot of questions about cost. What does this cost? Everybody wants to know, how much is this going to cost me? What does this cost? Well, at the end of the day, you can look at every single one of these years and follow it straight over and look at the cost. And here's a great way, here's a simple way to come up with the cost. What is your outlay? What can you cancel and walk away with? That's going to be your net cash value. So, what did you contribute, or what did it cost you in that year? Would be determined by how much you put in, how much you can get out. That's a simple way to figure out how much this cost. Okay. And at the end of the day, this can be very, very, very cost effective, especially after you hit that break-even point. Let's see. One or more policies. I get questioned. I do get asked quite a bit. One or more policies. Oftentimes, if you're looking at one or more policy, if you're looking at, let's say, this 35-year-old, and you said, "Hey, look, would it be better to start 2 policies on John Doe for $5,000 or one insurance policy for $10,000?" It's going to be 6 of one, half dozen of the other. There is no difference if you're starting them at the same time. Now, oftentimes people do have multiple policies because of maybe one on you, one on your spouse or your significant other. Maybe one on the 2 of you, and then if you've got kids, you can have policies on the kids. So oftentimes people accumulate multiple policies, and then other factors would be, hey, I'm 20 years old, I'm just starting out with my family, I can afford to put away $300 a month. And then 10 years down the road, you're 30 years old, and hey, I can start putting away $10,000 a year. Well, you don't have to redo that first policy. It's properly structured. Just add another policy and put the difference in that other policy. Okay. I think I've covered it enough. I've got a lot of questions here, so I'll answer a few of them. I'm going to try to wrap this up here in a few minutes, so I'll just address a few of these. Let's see here. Is the PUR at 65 and 90? Oh, he's left anyway. Is the PUA at 65 and 90? I'm not sure what the question was. He's gone anyway. Kathy, I wasn't going to address becoming your own banker in this one in particular. This was specifically for for understanding the policy a little better. What's the difference between whole life and indexed policies? Great question, Tony. There are a lot of differences. Again, to get into that is beyond the scope of this meeting. However, I will say that the chassis is completely different. The basis of the policy is completely different. A whole life policy it's what's called a permanent life chassis or permanent chassis, where the premium is the same day one as it is, year one is the same. It's the same price as it is at year one, at year 90. Indexed policies, you're referring to an indexed universal life policy. Universal life policies are based on a 1-year renewable term chassis. So the beginning years are very inexpensive. Later on in life, it can get very expensive. Okay. I alluded to it just a teeny bit, not knowing that this question was going to be coming up. But yeah, that 1 year renewable term chassis can be very expensive. And so it's kind of a gamble with the index policies, and your as the insured, you're taking back the risk of having that policy lapse or not. And with a whole life policy, you transfer the risk to the insurance company. With an indexed, with the universal life policies, because they are on a 1 year renewable chassis, you retain the risk, or you take that risk back on, because if the policy doesn't perform how they project it to, and their projections can be skewed, if your policy doesn't perform as projected, that term, the cost of that insurance does continue to increase, and it can eat the policy from the inside out. It can eat itself alive, and then at the end of the day, you get a letter from the insurance companies saying either pay up for the cost of the term that's increasing and very significant now, or your policy is lapsed. So that's the difference between a whole life and the indexed or the universal policies. And again, there's a lot more differences that are beyond the scope of this conversation. Can you show a 70-year-old? Great question. I would, if you want to get a hold of, if you want to contact us here at Paradigm Life, our phone number 800-870-8670. That's probably going to be the best way to go about that, to try to illustrate for every age is far beyond the scope of this. But anyway, our contact information is right there. Go to our website, paradigmlife.net. We've got a ton of resources, podcasts, blogs. You can just a lot of resources. So let's see. I can afford only $50 a month. Do they have whole life insurance for that amount? Yes, Keith. We would be able to accommodate you depending on your age and health and different things like that. So again, contact us here at Paradigm Life. I'm going to put the contact information back up here again. Contact us and meet with a wealth strategist. That's going to be the best resource there. Index universal life. Okay, does guaranteed and paid up additional cash value dividends all get guaranteed each year? Can you lose dividends that are not guaranteed from previous year? Great questions. Sylvia asked a question. What happens to your cash value once it's in the policy? Essentially, when you hit a specific amount of cash value in the policy, can you lose? And that's a great question. Sylvia, your total net cash value, every year that this is in here, this is the new baseline. You cannot decrease from that amount. Okay? Some insurance policies are invested in the market. And again, that's beyond the scope of this conversation. These are not. These are guaranteed products. If you have a balance of $189,000 in your cash value, that is the balance. The only way that's going to drop is if you take money out. Okay? Same with your death benefit. The only way that's going to be reduced is if you take money out or you stop making the premium payment, the base premium. Remember that one that's required. Oh, on that note also, I would like to add, that $4,000 is a required contribution from either your pocket or the growth from within the policy. So at some point, these will offset themselves. They will make their own base premium payment, and you are no longer required to make a payment whatsoever. Okay, what is the guaranteed interest on the base of the policy? Greg asks, what's the interest rate or the guaranteed interest rate on the base of the policy? That's going to vary, company to company, and it's beyond the scope of this conversation. Talk with a wealth strategist; they'll be able to explain and elaborate more on that. Where does IUL policy fit into the cost? Yeah, again, beyond the scope of this conversation. 3 is not guaranteed all the way back to the beginning of the policy. This concept seems like a universal life option. Okay, is it? No, this is very, very different than a universal life option or than a universal life policy. Very different. What is the taxation after 67 on non-guaranteed growth? Somebody's asking about the taxation. Great question, especially around tax time. Taxation on the cash value. Taxation on the cash value, and he said 67 in particular. Well, really any year. Looking at the cash value, you can withdraw up to your contribution without any tax consequences. So up to this point, 30 years with a $10,000 contribution, you've contributed $300,000. You could withdraw $300,000 and have zero taxes. Okay. Now, this is technically considered a tax-deferred type of a financial vehicle. The reason is because if you canceled the policy here at 65 years old and they sent you a check for $582,475, you would be taxed on the gain if you cancel the policy. Now, there are multiple ways to access your cash value. You could pull out $300,000 because that's what you have contributed at that point. Again, $3,000 at $10,000 per year. And then you could take a loan against the rest of your cash value because a loan is not a taxable event. Okay? So you have access, you have tax-free use of $582,475 at this point in this illustration without any tax consequences. You can utilize it tax-free, and then the death benefit is, or up to this point, has always been tax-free in whole life policies. Great question. Great question. Let's see. What is the lowest amount to contribute to make sense to build cash value and insurance value? 1,000 or 10,000. Sylvia, that's that there's going to be a lot of factors there. Age, how motive premium, what you're looking to accomplish. So again, contact a wealth strategist here at Paradigm Life. They'll be able to go over that in detail with you. Every situation is different. We don't talk about interest rates on loans. We didn't talk about interest. Okay, and how those works. Can you touch on that, Andrew? That's a little beyond the scope of this particular webinar. We do have other webinars. So again, if you go to our website, you can get on, especially when you get when you sign in, you'll have access to a lot of webinars. And go to our resources page. You're going to see a lot of that information. We have a tremendous amount of information on Paradigm Life. If you log in, we actually have a lot of. I'll show you here. This is my profile, of course, but you have a lot of videos that are available to you, and these talk about. I mean, these are going to answer a lot of the questions that you have. And then meet with a wealth strategist. They're going to be an excellent resource. Let's see. I'm going to put it back over to contact. Oh, there's a contact right there. So we have replay on this. I just got Kevin. Looks like you just came on. Yes. For those who registered, this will be available, and you should get an email regarding how you can rewatch this. Let's see. The The issue of pay to 121 years is also something always confusing to me. Sylvia, great question. Sylvia is wondering about the paying to 121. Again, that's out of your pocket or from the growth from within the policy. So you do not have to pay it for 121 years out of pocket. Okay, what is the difference between paid up addition cash value and the guaranteed and the non-guaranteed? Eddie went over this stuff. If you can rewatch, all that stuff is explained. If I die and my beneficiary receives the payout, is that payout taxed? Gene, no. Death benefit is tax-free, or at least up to this point it has. Now, I will not guarantee what our government will do and the changes they will make in the laws, because I have no idea, and I don't think they do either. Can you compare this to a buy term and invest the difference? Andrew, you know what? I have. It's beyond the scope of today's. But again, get with a wealth strategist. I've got a wonderful presentation about comparing this to buying term and investing the difference, which begs the question: why is that ever taught? I don't get it. And I, at the end of the day, I think those who are preaching that from the pulpit, without naming names, they will not have a comprehensive discussion with an insurance agent who sells whole life. They've been asked to a number of times and they continue to refuse. If that day comes, we will see what happens. Let's see. Okay, how can I get a list of the webinars? Derek asks, how can I get a list of the webinars? Go to our website. There's going to be some webinars on our resources page, and then also when you open up, you may or may not have seen this, but when you open, well, there's some webinars right there. Once you sign on to paradigmlife.net and create an account, you have access to additional things. Let's see here. Okay, I think that will do it. The questions keep coming in, and I appreciate it. Appreciate everybody attending. Again, please go to our website, paradigmlife.net. Please give us a call, and we'd love to meet with you and talk one-on-one for your particular situation. That's going to wrap it up. I appreciate everybody, and have a wonderful evening. Bye-bye.